Hello gurus, and welcome back to the channel and to our weekly update into our models and to the overall situation in the world. Now, the last couple of weeks, the entire news scenarios have been around, of course, the war in Ukraine, the Russia-Ukraine conflict, and that makes sense. But what I've also been saying in several of my videos is that there will be a time, and I think that time is around about now, where the market starts to become a bit numb to new war news. We know the war is there, but the first week everyone was in shock and no one had really accounted for the devastating invasion from Russia into Ukraine. But now it's there and people are starting to price it in, and we are at a point where yes, we are following the news and stuff, but it is not affecting the market as much. It can seem a bit cynical, but unfortunately, that is how the human psychology works. Now, before we take a dive into the different models here, I would like to have a quick look at some of the news, some interest, and some COVID-related news from China. And if we start with the China part, when we look at in the economic news, the last couple of weeks they have been filled with war news. But today we can see that European shares slumped 2% on worries over China's COVID surge. Now what happened is that China have closed down the Shenzhen, a very, very large city with I think it's about 17, 18 million people living there. And that is making the rest of the world quite worried, because if this is the start of your new COVID pandemic wave, maybe some new mutations, well, compared to or on top of the interest rate hikes and the war in Ukraine, this is definitely not good news. Now, this is just one thing. Then, of course, tomorrow we will have the, sorry, this was not it. We will have the FOMC meetings from Fed. And right now, or if we just step back and say, what about a month ago, there was quite a conviction in the market that we would see two rate hikes here from around 0 to around 50 basis points here. But due to the situation in Ukraine and the potential recession and downturn in economy that we might see all over the world due to this crazy conflicts, we are seeing some spikes in energy prices. We're seeing spikes in wheat, in food in general, transportation, and so on and so forth. Then I think it is fairly safe to say that Fed will only hike it by one step now, 25 basis point up. This is nothing compared to the inflation rates we are seeing right now at 7.9%. Today we are getting the PPI numbers from United States, kind of the inflation for producers, manufacturers, and that will end up around 10%, meaning the inflation for producers is 10%, and that will probably end out in the CPI, the Consumer Price Index, as well. So my guess is we'll see some rising inflation at least a while into the future now. But that makes the 25 basis point next to nothing. But they need to start somewhere, and hiking it by 50 basis point now could crush a lot. Now, looking at the future dates here, the 4th of May, you can see the market is a bit split. The pricing shows that 50-50 chance of a one rate hike or two rate hike, so either 25 basis point more or 50 basis point more at the May meeting. It will be interesting to hear tomorrow what Powell has to say and to look at the FOMC minutes in a week or two to see what their rationale is, the way they see the market for the rest of the year. But as we can see, there are definitely a lot of expectations for further interest hikes. So there's that. About the interest rates, then we can see here, we can see from the 2-month yield up to the 30-year yield. The 20-year is above the 30-year, and as we can see up here, it's getting pretty crowded between the 2 years and the 10-year yields. The 7-year have run past the 10 years, And if we just look a bit back here into the October 21, just at a random time here, we could see that there was a 1.25% difference from the 2-year yield up till the 10-year. If you're looking at the same distance between them now, we are seeing around 1/4%. So that has shrunk from 1.25% to 1/4%, meaning that we are definitely getting closer to what is called an inverted yield curve. And this is it. You can see the short-term yields here, the long-term yields here. And in a normal market, they should look something like this, where you are getting a lot more interest for taking a longer-term risk by tying up your money here. But in this market, we can see that this is getting very skewed, and we might see this one shooting up at some point while these are shooting down. That is, if the markets are getting very nervous about war and COVID and everything, then people are running into long-term bonds, meaning the yields are going down. And this one is shooting up with the Fed hiking the rates. So basically we might see an inverted yield curve, which in most cases are a predecessor for a recession. But with the inflation we're seeing right now, if we're running into a recession, it will actually not just be a recession, which is 2 quarters in a row with a negative GDP growth, but it will probably be a stagflation if we get to that point where we see a recession and very high inflation numbers. So there are a lot of troubles in the market right now, but let's have a look at the different models. Or first of all, we could look at the oil. Look at this one. The war in Ukraine made energy go completely crazy here. And then due to a lot of different factors, the oil topped here. First of all, it was kind of overbought. Then OPEC plus countries, some of them were starting to say that they might turn up the production a bit. Then there was some kind of promising peace talks in the Russia-Ukraine crisis. And then there is a COVID thing that makes people worried that we'll see a downturn in the economy, meaning that oil has have dropped 25% in a week or so. That is absolutely crazy, just as crazy as this really high spike here. But let's have a look at some of the models here. The weekly momentum models is actually starting to do pretty well in a tough market. If we just have a look at it here, we can see, as I've talked about a couple of weeks, it seems like it has bottomed out here. And we're still down 18.5% for the year. But we can see here that for March by now, 2.62% up, which is actually fairly well. And this one, if the market really bottoms out and we start to run upwards, then this is something that can easily have months with 6, 10, sometimes even 15. Yeah, we have 17% in February last year here. So it is, we only need a couple of these months here, then our entire loss for the year to date is pretty much eliminated here. So let's hope that happens. The monthly momentum models has of course rotated into new stocks here at the 1st of March, and that also seems to have bottomed out a bit. Also minus 18 point something percent here. And we can see that it has actually been in the positive, but have turned downwards again into the negative here for March. And that is probably because it was sent into some energy stocks that have now turned around the last couple of days. But let's see where that ends. Again, we can see we have 11% here, 10%, 7%. So we only need a quarter or so like this. And all of a sudden we are close to break even for the year. I have a good feeling that we will end the year in the green. Quarterly momentum, as you know, rotating once per quarter. This one has not completely bottomed out yet, and that is because we're still in the stocks that we took in January after the risk off, but we are rotating into new stocks in a couple of weeks, so that should send us into a bit of a better stocks. Down around 20% here, and as you can see, 4.8% for March so far. So we're looking for a real bottom in this one, but I guess it will be here in April, May, June, and then we'll see some upwards movement there. That is at least what the statistics are telling us. For the ETF strategy, we can see here 7.8%, which is a record drawdown for this model, which is fairly conservative, but one of its flaws, if you could call it that, is that it is short in oil. And therefore, we are seeing this drop right now with the extreme rise in oil rates. So if the oil really starts to drop now, we will see a very good improvement here. And as you can see, this is the loss that is primarily due to the movement in the oil price. But let's see, this is an extraordinary situation with potential stagflation, recession, new COVID cases, a war going on, and pretty much a beat up economy in both Europe and United States. The last model here is the Ultimate Dual Momentum. If we're taking a look at that one, you can see it has a year-to-date of 12%. It's actually the best of the models so far, or the least bad model so far. 4.1% here in March, but only minus 12% for the year. And again, this is a model that in the historic perspective can easily go through a drawdown like this and then turn upwards and give us some very good results for the rest of the year. So these are the models. Let's hope that the market and the models are bottoming out right now. I'll be back next week, and we will also have some more interesting videos for you in the meantime. That's all for now. Take care of yourself and your money out there. Talk to you soon. Bye.